So it's the end of July 2022, and I feel like everywhere I turn, all I hear about are iBonds. And I just want to take a minute to talk about why I'm not purchasing iBonds. Right now, they're paying a guaranteed 9.62% annualized. And of course, that rate adjusts every 6 months. If you're not familiar with iBonds, they are a US Treasury issued bond, which pays a guaranteed interest rate plus an inflation adjustment on top of that. And that's pegged to the consumer price index, which adjusts every 6 months, essentially. Right now, the fixed interest rate on those is 0%. And then the inflation adjustment to keep up with inflation, that's the rate that adjusts every 6 months. And so if you annualize that current rate, that's how you get the 9.62%. So as someone who is still a few years away from my projected FI date, I'm 24 months away as I'm mapping it out, iBonds they are not appealing to me at all. If you're someone who needs a cash position, like for example, you're already retired and you maintain a cash bucket like my co-host for this show, Jason, iBonds can be a pretty good option. You know, you can get $10,000 worth of iBonds per social security number. You can also get one for, you know, a business, your LLC if you have one. You can also get one for any trusts that you have. So, you know, there's some flexibility in there, but if you're talking about, you know, a portfolio that's growing toward retirement size, it's probably not going to move the needle that much. With all the talk about iBonds, I'm just surprised that none of the commentary talks about the opportunity cost of investing in iBonds. And so as I look at it from my own personal situation, whether you're 2 years out like I am, or you know, you have many more years to go, it seems like the opportunity cost for investing in iBonds is pretty large. For me, the better play is to continue investing in this market. If we look at the typical bear market, a typical bear market lasts about 13.8 months, average bear market, and the average bear market loss is about 35%. Right now, currently in July of 2022, the S&P is down something like 22% off of its recent highs, and we're about 7.5 months into this bear market. Typical bear market lasts 13.8 months, so if it's an average bear market, we're about halfway through. Who knows how much further this market could slip down? We're at 22% down. If the average bear market is 35, we could have a ways to go here. But what I love about this continual investment strategy in the market is that I'm buying all the way down. So I have a weekly buy scheduled, make one every Thursday. With my investable assets, I am dollar cost averaging in, and unfortunately the market has been going down. But at some point, we're gonna reach the bottom of this market, and we're gonna be ticking along the bottom here, or scraping along the bottom maybe for some period of time, and then at some point, it's going to start to recover. And the real benefit here investing in this kind of a market is once the markets do start to recover, they tend to recover pretty quickly. If we look at average returns just 1 month after the bottom, they're at 15%. And if we zoom out to 3 months, they're at 21%. And on out to 12 months, average returns are up to 43%. And if we go even further out to 24 months, the average is 62%. And of course, we all know that the key to capture these returns is to remain invested and to continue to invest even through all this volatility. Now, to put this all in context, in order to make up a loss of 22%, and I don't know if this is the bottom of the market or not, but let's just say it's 22%, we actually need to earn 28.2% to recover from that 22% loss, right? It's not just 22%. It's not going to get us back to our original starting position. We have to earn a little bit more. So if we're talking averages, and we look at the average bear market, which loses 35%, the average returns in the 12 months following those are 44%. So much higher than our recovery target rate of 28.2%, right? And then if we start to compare that to the 9.62% annualized return rate on the iBonds, you can see that looks a little bit paltry by comparison. Now, of course, these returns are not guaranteed. I mean, I just want to say that here. Whereas the iBond returns are locked in and fixed, and they adjust every 6 months. So if inflation keeps going up, these rates could continue to go up. If we think inflation has peaked, these rates will continue to go down. And at some point, it will reset to the normalized rate, and your iBonds will be earning next to nothing. If you're a long-term investor, you also have to be thinking ahead to how you're going to unwind this position ultimately, right? You'll ultimately sell these, you'll realize the interest earned, and federal tax will be due on that. And those taxes are due at your ordinary income tax rates, okay? So it's not a preferential treatment, whereas if you bought $10,000 worth of VTI, an index fund, when you realize those capital gains, you have more control on how you're going to pay the taxes on those. So you have up to $83,350 in 2022 of headspace in the 0% capital gains tax bracket. This is presuming you're married filing jointly. And you'll pay a 15% capital gain on anything between there up to $517,200. So this is just some food for thought from my side of FI. Pre-FI, I'm 24 months out. I think the opportunity cost of buying iBonds versus investing in an index fund, low-cost index fund, it's pretty high actually. And so I hope this helps you make your decision.